Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a huge welcome to the community. My name is Bryce, and we have a jam-packed episode today. To chat through it, as always, is my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We have a big slate of content we're going to cover. The best performing super funds of the financial year has just dropped.
Yep.
We're going to go through them all and compare how we did to them.
Yes.
Our own very own compare the pair, if you will.
Yeah, nice.
Sun Cable, has taken another step forward. We'll explain what that is and why it is exciting. Stories about Drone Shield is happening. We've got a question about investing or putting your money in your offset. And we're back with another Pimp My Portfolio with Adam Dawes. A jam-packed episode. Let's get into it. Where do you want to start?
Well, let's start with
News and markets.
So this week, the best performing super funds for the financial year 2024 were released. Hot off the press, Ren, we have the top 10 here.
Now, these are growth funds.
Yes.
So we have said, don't worry about balanced and conservative. If we want to see best performing, we should be looking at those that are optimized for growth.
Yeah.
Optimized for performance.
Yeah.
Now, for context, the ASX 200 returned 7.8%, and the S&P 500 over in the States returned 22.7% in the same time period.
Yeah.
So with that context, Bryce, which way do you want to go? Do you want to go top to bottom, or do you want to build up to the best performer?
Let's build up to the best performer. Let's start with the median.
Nice.
Which was pretty impressive. So the median for all super funds surveyed in the growth category was 9.1%. So outperforming the ASX 200, but well below that of the S&P 500. So not bad. You would take that over a 20-year period.
Yeah, well, I mean, to be fair, you can't compare it to the S&P 500 when they're benchmarked against the ASX.
I don't subscribe to that view, but sure. If the super funds should just
True. It's an
make
option.
me money.
It's an option that you have to invest in if you weren't in that super fund.
Yeah.
Fair. We'll bring that up with.
Yeah, we've got a few views on this. Anyway, so coming in at number 10 was Aware Super at 9.6%. But let's move to the top 5. So equal fifth was Mercer Growth and Qantas Super, both 10.1% for the financial year. Coming in at number 4 was Brighter Super, 10.6%. And then we had 3 sharing the gold prize. We had IOOF Balanced Investor Trust, the Colonial First State First Choice Super, and Mine Super at number 1, all 10.7%.
Wow, there you go. 3 equal winners. Mine Super, which is for coal miners, I believe, an industry super fund, and then Colonial First State and IOOF.
Second year in a row that Mine Super has taken top spot.
Yeah.
So good to see. If you look at the 10-year returns, the top 10 are made up of all industry super funds, and Host Plus actually takes the number 1 spot for total 10-year returns at 8.3% per annum over the last 10 years. So if you're in Host Plus, you're doing pretty well. And the Australian Retirement Trust comes in at number 2 over the last 10 years, 8.1%.
Well, Bryce, I think you've just cut the next industry super fund ad read based on that stat. That's surprising to me.
That they're all industry super funds.
That all 10 of the top performing growth funds over the past 10 years are industry.
Why is that surprising?
Because, it shouldn't be that industry super funds don't have some, crazy investment edge. They have lower fees on average, but they shouldn't take all top 10 spots.
I guess so.
Are you not surprised by that?
Not
there is no reason that an industry super fund should have this level of outperformance across the category, you know?
Yeah, I understand what you're saying. I have no reason for it.
Especially because a lot of the industry super funds are bigger, and in general, bigger funds find it harder to continue their outperformance.
Well, it'll be interesting to see the next 5 years if that holds, because there's definitely some in this year's top 10 that are not super funds that have performed.
That are not industry
that are not industry super funds. And some of those industry super funds aren't in this year's top 10.
Yes.
So Riddle me that.
Yeah. I guess the two arguments around why they all are industry super funds in the top 10 are, first of all, it just reinforces what we say about fees.
Yeah.
Like fees matter,
yeah.
especially when a lot of these funds kind of track or hug the index. The difference in fees make a big difference. And secondly, when we talk about super, potentially the bigger they get, the better deal flow they have, the better access to private investments, and maybe that is where their edge comes from.
Yeah.
But look, my final takeaway, Bryce, all of these super funds have done very well. None of them have done well as VDHG.
That's correct. So we had a look. If you were to just take your super fund and invest it in Vanguard Diversified High Growth Index through a number of platforms that allow you to do that, it has returned just shy of 13% over the last 12 months. So over that same time period. So,
and that's not a Vanguard special thing. I'm sure if you looked at BetaShares, DHHF, any of those like globally diversified one ETF funds, they would have done well. So take of that what you will. Let's keep moving.
That's right. We'll unpack more on that. But something else that is caught our attention is the Sun Cable project, Ren, is back on the table.
Yes. Now, for people who are unfamiliar, this was backed by Twiggy Forrest and Mike Cannon-Brookes, the two Aussie billionaires. They wanted to build one of the world's largest solar farms, about 800 kilometers outside of Darwin in the Northern Territory. I think it was 10 gigawatts and like 12,000 hectares of solar panels. They wanted to generate electricity there, transport it via overhead cables, 800 kilometers to Darwin, and then on a 4,200 kilometer undersea cable, transport that electricity to Singapore, where they plan to provide the city-state, 20% of the city-state's electricity needs.
It's crazy.
Now, that was the project. Mike Cannon-Brookes and Twiggy had a bit of a falling out, and the project actually went into receivership, I think last year, 2023. Twiggy wanted to keep the electricity onshore and convert it into hydrogen as part of his hydrogen plans. Cannon-Brookes wanted the original plan to go ahead. It kind of felt like the project had died. So we were all very surprised to see yesterday when the project in its original form to transport the electricity to Singapore got environmental approval. And apparently it's on track for 2027 still.
Crazy. The thing that frustrates me a little bit is that it's going to, as you said, 20% of Singapore's power.
Why does that frustrate you?
Well, bring it home.
Yeah.
We could do with that.
I think, let's not get too far into this rabbit hole, but poles and wires become very fraught in terms of how you build renewable projects, how you connect it to the grid in Australia and stuff like that. And potentially it's easier to build a 4,200 kilometre undersea cable than it is to deal with Australia.
Unbelievable.
Yeah. But look, it's not like there's not a whole bunch of renewable projects happening in Australia.
No, of course, yeah. Well, at the same time that news came out, Ren, Fortescue came out and said that they're slashing 700 jobs and Twiggy's hydrogen dream is effectively over for now. So, tough times for Twiggy.
Yeah, the Australian market and the Australian Energy Market Operator (AEMO) also came out and said they didn't think the nuclear plan was a good one as well. So, that's not a political statement. That's just a reality of the plan and our needs in the next 20 years statement.
Yeah. Anyway,
final thing, just to touch on the news of Drone Shield. It fell 30% in a day, recovered a little bit, was down 20% in one day. Then the next day it fell about 20% again. So we should touch on it because a lot of people have invested in Drone Shield. A lot of people have enjoyed the ride. It was up over 400% year to date, even after the fall. Nothing fundamentally changed about Drone Shield. There was a couple of short sellers who came out publicly and a couple of news articles that were written about it being overvalued, which, is fair.
Yeah.
It certainly looks expensive.
Yeah.
But it's growing. So if you're invested in Drone Shield, if you're watching Drone Shield, nothing fundamentally changed. It's just market sentiment. I have no idea where it goes from here.
People will take the opportunity to buy in.
Yeah.
Anyway, that's news and views. Let's move on.
This is Pimp My Portfolio. Pimp My Portfolio.
That's right. It is time for Pimp My Portfolio, where we bring in an expert and a community member to get their portfolio pimped. And today we have joining us on the line, Oliver. Oliver, how are you?
Not too bad, thanks. How are you guys going?
We are going very well. Thank you for submitting your portfolio. And today in the studio, our expert is Adam Dawes. Adam, how are you?
Right, yeah, really good. Great to be here.
Alrighty. Well, as usual, Ren, can you tell us what is in Oliver's portfolio?
Yeah, so Oliver's got quite a concentrated portfolio, 12 positions, a number of individual stocks, and then two thematic ETFs. So some of the bigger holdings, we've got Goodman Group, 25% of the portfolio as the biggest holding. Coles, second biggest, 17%. And then Drone Shield at 16%. Bizalloy Steel is the fourth biggest, which I think has done all right recently. So well done there, Oliver. The two thematic ETFs are is ACDC, the battery and lithium ETF.
Yeah.
And then QRE, which is the BetaShares Aussie Resources ETF. So, Dawsy, with all that said, do you have a nickname for the portfolio?
Well, in ode to Oliver Twist, I'm going to say, can I have some more, please? Because I think this portfolio is absolutely looking really good. Needs a little bit of fine-tuning, but I think it's pretty good.
Wow,
Nice.
there you go.
Wow.
Well done, Oliver.
Oliver, segment over.
Gee whiz.
So,
Gee
maybe,
whiz.
Oliver, tell us how this portfolio came to be, how you built it.
Well, it's a long story. I've been investing probably since 2021, mid-2021, and I've just slowly built it. It's mainly just trying to find things that I enjoy and things I find interesting. I think so. I started listening to Equity Mates mid-2021, and I sort of got an idea of a few companies and went from there. I got into, I suppose, looking into industrials. So one of my first ETFs was QRE. So getting into those mining sort of stocks, and you could probably see it from my portfolio. I generally like the companies that are, dirty in the sense of they work with dirt.
Yeah, true. Yeah, I can say that.
And yeah, I've just slowly built it from there. And then I started looking into defense. So that's why I've got Drone Shield, which is a complete fluke. I bought that at 19 cents. That's done pretty well. And Bizalloy Steel, which does armor, does a little bit of armor, mainly just hard-wearing steel. But yeah, I've just sort of invested in what I enjoy and what I would find interested in following up with. There's a few companies in there that I want to expunge that are just not interested to me anymore, such as A2 Milk. I mean, I don't really care about milk, so I don't know why I got it, but there we are.
Yeah, Oliver, and thank you for the rundown, because I think everybody should listen to what you talked about being interested in a stock. You should never really invest in a stock that you don't understand, right? So a lot of biotechs, a lot of those kind of companies I don't understand, and I've been doing this for years. But so looking at companies that you understand, that you have an interest in, I think absolutely is the way you should be investing, because then that gives you the ability then to look past potentially what the directors are saying, what the company's saying, and actually look at the industry or the subsector behind that, which then gives you more information, which then keeps you involved in the portfolio. A lot of the time we see portfolios that are forgotten. They're just sort of stuck in the bottom drawer, haven't been looked at, and they suffer from that. So I think that's great that you're taking an interest and looking at stuff that you understand. So I think that's perfect.
So, Oliver, I don't have how your portfolio's gone, but I'm just looking up some of your holdings and how they've gone in the last year. Drone Shield up 630%, Bizalloy up 133%, Goodman Group up 73%, even A2 Milk's up 36%. So
Yeah.
you must be feeling pretty good about your investing track record.
Some of them indeed have gone really well, but there are some pretty heavy draggers in there, such as I think it's Kalex and
Kalex, yeah.
Magellan Fund
Magellan.
Group.
True. Yeah. Calix down
So
66%.
it sort of evens out a little bit.
Yeah.
I think for me it's like nearly 80 or 90% or something like that. So it's pretty rough. I sort of picked out industries that I knew would do relatively well. So I have a lot of property in there, and industrial property being Goodman, industrial property has crazy valuations. And that was one of my first holdings as well. So I knew that would do relatively well, but at the same time, I've made some pretty poor mistakes as well, as with Calyx and Magellan. And I think A2 Milk was a heavy dragger at one point too.
So we're here to pimp your portfolio, and Dawesy is playing the role of exhibit
Yeah.
for people old enough to remember Pimp My Ride. So Dawesy, how would you pimp this portfolio? Where are you looking at for areas that could be improved or enhanced?
Yeah, well, as Flavor Flav said, it's time to get serious. What if everybody remembers Flavor Flav, Public Enemy? They're great. Anyway, what I would think of is to pimp the portfolio. I think obviously you need to have a trading strategy. One of that is that if you are looking at stocks, and if you're depending on if you're a long-term buy and hold, or if you are trading, but you still need to have a strategy around that. I think Calyx is a fantastic business, and I'm long and wrong for many of my clients on it. I still think that one's going to go well. But however, if you got that trading strategy that, you run a stop loss on your portfolio, or run, if it's down 20%, get rid of it, those kinds of things. If it's up 50%, sell some, that kind of thing. So having a bit of a trading strategy around that so you don't get caught in a Magellan style downtrend and holding on, thinking things were going to get better. And Calyx as well, it's been a tough one for investors. In saying that, you don't have any international really the Global X ETF. And you could argue that some of those stocks like Drone Shield is more of an international, Paladin is an international one. But I'd look for some international ETFs to broaden out that performance. Australia is only 2% of the world's index, whereas there's 98% of opportunity that you're missing out on. And obviously the US has had a fantastic run over the last 6 to 12 months, coming up to 12 months from November last year. So they've had a fantastic run as well. So you'd be looking to diversify out. I don't mind thematic ETFs, but thematic ETFs do run their course. And we have seen that with ESPO, so sports betting, all of these kinds of things. They sort of have their moment in the sun, and then they sort of fall off, and everybody sort of moves on to the next thing. So be a little bit careful with those thematic. I think the ACDC one is probably a pretty good one, but yeah, the Beta Shares Resource ETF, you need to look in under the hood. You've got a fair bit of resource exposure in there with uranium, those kinds of things. So be a little bit careful. What's the one behind Rural Funds Group? Is that just for income, or you like chickens, or what is that one about?
Oh, yeah. So that's another property one. So that's a REIT,
Right. Yes.
and I wanted exposure to agriculture. I did have Grain Corp, and I had the food ETF, Beta Shares, and they just weren't tickling my fancy. And I thought just the Rural Funds Group owning agricultural land was a bit more. Had a bit more diversity in agriculture, and plus it had the helping hand of it being actual property, so it had a good net tangible asset value.
Yep.
So
you're in
if
property,
anything goes,
is that right? It sounds like you know a bit about industrial and REITs. Is that your job, property?
It's not, but I did a university degree in property.
Right. Okay. Yeah.
So yeah, I know a wee bit about property, but not too much.
Yeah.
But yeah, so just the property can be quite flexible. So it could be working property, and then it could change from agricultural to just your residential, and then that's where they can make a lot of cash.
By
spinning
absolutely.
it out to residential.
Absolutely. And Goodman Group's just done fantastic. It's the best industrial ETF REIT business out there, and with data centers now, they've just got this huge resurgence. So you would definitely be holding that one for the longer term. Viva Energy also, a little bit of a tough one there. They just did a big acquisition of On the Run, which is a big South Australian sort of convenience store, which they're sort of rolling out. Refining margins have been a bit tough as well, so that's an interesting one there. So I think overall the portfolio is well set up, but I would definitely look to get some more blue chips in the portfolio, as well as then I'd look to get some international for that diversification that you need in the portfolio.
Yeah, I've been looking at trimming potentially. You might have a better idea. Some of my profits and potentially putting him into the S&P 500, but I might do that during the presidential election when things are a little bit more volatile.
Yeah,
Play my card, you know.
presidential election. I think you potentially, and this is not advice, but you would potentially look to move before interest rates start to fall in the US. Potentially that might be an August, September period. And then you've got the lull of the reporting season that'll be coming through as well. So there's a window of a month or so that will be lack of news, but also there will be talk of interest rate cuts. And I think they're at least going to want to get one interest rate cut before Trump gets in. So that would potentially be a way for you to position and time that entry into that S&P 500.
Yeah, I feel like trying to predict the future direction of the stock market is hard. Trying to predict the future direction of US politics and how that will affect the stock market is near impossible. So
yeah, agree.
Yeah. But Oliver, if you can do it, then give us a call and let us know as well.
Oh man, I'll try.
But look, I think there's some good things for you to go away with there from Dawesy. But I think, well done on building the portfolio to date, picking some big winners, and hopefully this has helped, and good luck with your journey from here.
Well, thank you very much. I really appreciate the call.
If you would like to submit to Pimp My Portfolio, head to equitymates.com/contact. All the info is there. But if you'd also like to get some professional advice on your portfolio, you can contact Adam Dawes as well through equitymates.com/advice, and we'll connect you with Adam and the team. But Adam, as always, thank you so much.
Thanks so much. Great to be here.
So we're going to take a quick break. And on the other side, we've got a community question, the classic, should I invest or put money in my offset? We'll be right back. Welcome back to Equity Mates. We've just covered news for this week as well as a Pimp My Portfolio session with Adam Dawes. But Ren, it is time for...
Let's ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, I've got a question.
Your
Questions.
answered.
Now, the question today comes from Ben. He has recorded it as a voice message. If you want to ask your question, would love it if you could record it as well. If you go to our website, equitymates.com/contact, there's an option to record it there.
Hi, Equity Mates. My name's Ben. I'm a big fan of the show and would love to hear your thoughts on my current predicament. My partner and I, similar to yourselves, became first home owners last year. Currently, we have a $700,000 mortgage at 6.2%, and I'm faced with a dilemma. I can place all of my funds into the offset account to reduce the interest on our mortgage for technically a guaranteed ROI of 6.2%. Alternatively, I can invest those funds into something safe like an index fund in hopes of achieving a higher return. I'd also like to contribute more to my super, especially after listening to your recent podcasts, but I'm conscious that every dollar taken out of my offset account results in more interest being applied to our mortgage. So I'm wondering, is this something you've had to consider, and how have you guys navigated this dilemma? Thanks for your insights.
So Ben, thank you for your question, and it is certainly something that we have considered, and it's something that everyone considers in their own way. For people that have a mortgage, I guess they have three options broadly. They can invest it inside of super, they can invest it outside of super, or they can put it in their offset. But also, for people that don't have a mortgage, you still have the choice of investing inside of super or outside of super. And I think the place that we want to start is two just general points. First of all, everyone's goals and circumstances are different. And so we'll talk generally, we'll talk about how we think about it, but you've really got to think about what you want out of your life and your money, because it is personal. So that's important to stress. The second thing to stress, whatever choice you make is a good choice. Investing inside of super, investing outside of super, putting it into your offset, you're taking steps to build your wealth and to set yourself up for the future. And so whichever one you decide, just be confident that you're taking positive steps. Because a lot of people get torn up about, am I making the right choice? But just know that by doing any of those things, you're doing well. With that said, Bryce, let's get into the choice.
Nice. I thought it's probably a good point to start by explaining the power of an offset account to those that don't have one, thinking about getting a mortgage, because they're pretty powerful. So the idea of an offset account is that the cash sitting in your offset account is reducing the interest that you pay on your home loan to the value of 1-to-1. Meaning, if you have $800,000 as a loan and you have $100,000 in your offset account, you're actually paying interest on $700,000.
Yeah. Now, I think the really important thing to stress is like your monthly repayments don't change. It's just the percentage of that repayment that goes to paying interest and the percentage of that payment that goes to paying principal, like paying your loan down, changes.
Yes.
Now, there's an example that you used on our Instagram. And so if people aren't following us on Instagram, you're missing some great videos of Bryce walking and talking finance. You used an example of a $500,000 loan and $20,000 sitting in the offset. So not a crazy amount of money sitting in the offset relative to the size of the loan. Just having that $20,000 sitting in your offset over the life of the loan will save you $90,330, and it will pay off your loan 2.5 years faster. Now that's assuming that you've got a 6.25% mortgage rate, which is kind of what we're seeing in the market these days. So just that $20,000 sitting in your offset saves more than 4 times that over the life of the loan from reducing your interest payments. So they're powerful.
Very powerful, yeah. The other thing that Ben noted was that it is a guaranteed return. And what we mean by that is because you're paying less interest on your loan, you're technically saving money, but that money that you're saving is after tax. So you're not paying tax on that. And so you are guaranteed that savings or that return.
Yeah, so like the equivalent, it's not like if I got 6.2% in the share market, it's the same. Based on your marginal tax rate, you probably want, you need like almost 10% return in the share market to get the equivalent of that 6.2% saving from your offset.
Yes. So while you get the guaranteed return, the second part of the equation is the stock market equation. Should I chase higher returns? So just a gentle reminder that the long-term returns of the stock market here in Australia, ASX 200, 13.2% since 1900.
Yeah, 1900 to 2022, that's 122 years of stock market history, 13.2%.
Yes.
Including dividends.
Including dividends. So it's a very powerful way to build wealth over the long term. So what Ren said earlier, either or are great alternatives.
Yes.
You're doing the right thing if you're doing either or. But how do you balance it? Well, mathematically, if you're comparing the two, there is a mathematical answer to it. If you want to put your money outside of your offset account, as you said, Ren, you need to expect to generate returns closer or above 10% because you need to consider the tax that you're going to pay on that. So you can do the maths on that. However, I think most importantly, it really depends on your overall wealth goals. And this is where we can talk personally to our experience. Because if you're piling all of your money into your offset account to pay down your home faster, you don't like having debt, you just want to get that done. That is all well and good. You might find you get to a point in your life, though, where you are debt-free, but you have no other assets outside your superannuation and your house, which might be what you want. But if you then want a portfolio of stocks that are going to create income for you or that you can use later on in life, you're going to have to play catch up on doing that. And that's the way that I think about this.
Yep.
What about you? How do you think about it?
Exactly the same. You can't. I was about to say you can't eat a house, but that's probably not like the clearest analogy. But the flexibility that I want later in life won't come from having a fully paid off primary residence and a growing super balance. Because when I'm 45 and I'm sick of podcasting and I want to take 6 months off, I can't draw on either of those assets. Asset rich, cash poor, not liquid, all of those things. But ultimately how I think about it is like the taco ad, why can't you have both? Yeah. And so to
Not
speak
mutually exclusive.
To speak personally about how Alice and I are managing our offset, so we have automatic transfers set up to our offset. And, we split the mortgage equally and we each contribute more than our share each fortnight when we get paid, if that makes sense. And so it's like we're slowly building up the offset every fortnight every time we're transferring money into it. But then at the same time, I also have an automatic transfer set up to my stock brokerage, and I'm dollar cost averaging into a portfolio of ETFs at the same time as well. And then I also have a little going to an account where I can buy stocks as well. But that's a smaller percentage compared to those other two.
Nice.
Much smaller percentage than compared to the mortgage offset.
Yeah.
But for me, at this stage, I'm not contributing any more to super, because I'm like, after doing that, I'm stretched, and like that for me is what I more want to do: build the offset up and have a portfolio of stocks outside of super to give myself that choice. I think you can strive towards both goals.
Definitely.
It's just like both goals are going to take longer to achieve. But yeah, that's how I'm approaching it.
Yeah, I agree. Not mutually exclusive. And should you get bonuses or, come into tax returns, those sorts of things, offset's a great way to sit cash while you think about what else you might want to do with it as well. Like anything that goes into there. At the moment, we find between Harriet and myself, if we get to a sort of certain level in our savings account, we just flick it across to the offset, because it's like, we don't need this money right now. It's being saved. Sit it in the offset. And we actually find psychologically that it probably stays in there longer than if it were to sit in one of our other savings accounts.
Why do you have a savings account?
Things like travel, for example, saving for Bali, last 12 months, it would be sitting in a savings account. But now we're like, because psychologically we don't want to draw out of our offset account.
Yeah.
We just want that to sit there and be distinct.
So we're quite limited in the banks that would lend to us.
Unfortunately, ANZ, who we're with, doesn't have multiple offsets.
Yeah, I was about to ask that question. Multiple offsets.
Yeah, I looked into it.
Yeah, okay.
Frustrating.
Yeah.
Yeah, so I've probably...
Well, let's put the call out to ANZ. I'm not sure how much we could change, but how hard is it to allow multiple offsets?
Good question. ANZ, hit us up. We want to know. But anyway, this is a question we get asked a lot. As Ren said, check out our Instagram. We do a bit of content on there. We also have an Ask an Advisor with Dylan that has been released, where we cover this question as well. If you would like professional advice, though, head to equitymates.com/advice, fill in the form, and we'll connect you with one of our advisors who will be able to help you work through this, because there are individual ways in which you can really maximize this, but it's just based on personal circumstance. But anyway, Ren, that brings us to the end of today's episode. If you have any question that you would like to submit, head to equitymates.com/contact, leave us a voice recording, and we'll make sure we answer it on the show. But as always, great to chat stocks, Ren. We'll pick it up next episode.
Equity Mates! I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.